Good afternoon, everybody, and welcome to our discussion on inheritance tax changes. What next? We have an expert panel here from Kreston Reeves to explain what the changes are to the relief available on qualifying business and agricultural assets, together with the introduction of inheritance tax on pensions. So for those who don't know me, my name's Mike Dyer. I'm a partner in Kreston Reeves and head of agriculture with over 35 years of experience in dealing with and advising businesses and owners across a wide range of sectors. It's great to see that there are so many of you on the webinar today, which just shows the strength of feeling and concern that the first budget of our new Chancellor and the government introduced some 5 weeks ago now. For those of you who don't know Kreston Reeves, we're here to help our clients with so much more than just accounting, business and wealth advice. We support you in achieving your ambitions so you can reach your brighter future, which is why we also host these webinars to help with any questions you may have. So we'll just start with a few housekeeping points. So this webinar is being recorded, and a recording will be sent to you all tomorrow. IT permitting, we will be asking for a bit of interaction by taking some polls throughout the webinar so we can share the results with you and generate some further discussion. There'll be a pop-up survey at the end of the session today, and we'd be really grateful if we could just spare a couple of minutes to provide us with some feedback. We've already had some questions sent in, but please do continue to submit your questions throughout the session by using the question functionality, which hopefully is shown on the screen. I'll leave that there for a moment while you familiarise yourself with the function, but suffice to say that the impact of this budget has sent shockwaves across the business community, with the biggest impact, on inheritance tax that business owners have seen probably since the introduction of the modern form when the tax was introduced in 1986. Although interestingly, the earliest form of death duties, probate duty, dates back to 1694. The Office for Budget Responsibility estimates that the impact of these changes, combined with the freezing of the thresholds, is that the proportion of estates paying inheritance tax will increase from 5.2% last tax year to 9.5% in 2029-2030. So almost double the number of the estates will be paying inheritance tax in 5 years' time. This will increase the tax take from roughly 8.3 billion in the current tax year to 13.9 billion, an increase of more than 67% over the next 5 years. A significant number of changes were introduced by Rachel Reeves, including restrictions to the reliefs for agricultural and business property, with harsh limits of £1 million to be imposed where previous no limit existed, and the restriction to 50% relief for values above that sum. The introduction of pension pots into the inheritance tax net for the first time, as well as increases to employer national insurance. Whilst a lot of the press has been focused on the impact of farmers, who are largely asset rich on paper but cash poor, the restrictions to APR and BPR affect all businesses and business owners, which has not yet seen much traction in the media. As you'll hear later, it's worth noting that some of these changes have been deferred until April 2026 for APR and BPR and April 2027 for pensions, purportedly to allow consultation. So the first thing to say is don't immediately panic. Given the backlash that the new government suffered on the winter fuel allowance withdrawal for pensioners, other than those on the lowest incomes, there is the possibility, however slim, that these changes may be watered down over the coming months, possibly by revisiting the level of the cap on APR and BPR, and possibly by exempting some amount of the pension funds being brought into the inheritance tax net. And who knows what the rules will look like in 5 years' time, after the next election and potentially after a change in government. Having said that, it's vital that individual positions are reviewed and that planning is considered to try to mitigate the impact that these changes will have on businesses and individuals' wealth. This will include consideration of both risk and age profiles. And as Jeremy Clarkson said, that well-known entrant to farming after the budget, just look after yourself for 5 short years, but sadly, not everyone will have that opportunity. I can foresee that the impact of these changes, particularly on APR and BPR, will result in the number of particularly multi-generational businesses being forced to sell up, downsize, or reduce growth plans in order to fund increased death duties. So this webinar will provide not only some of the detail on these changes and their impact, but also some thoughts on planning options and how to manage the risk. So now it's time for me to introduce our panel. So on screen we have Daniel Grange, Partner and Head of Tax, who will talk about the changes introduced in the budget and cover some of the planning options. Gemma Spencer, Head of Private Client Legal Services, who will discuss the importance of reviewing your wills, and Terry Burgum from Kreston Reeves Financial Planning Services, who will cover pension planning options, life insurance and other investment products to help mitigate the risk. But first, I'll hand over to Daniel, who will be covering the changes introduced in the budget, as well as some of the planning options.
Thank you, Mike, and good afternoon, everybody. So I'm sure you will all have read or seen a lot of coverage about the inheritance tax changes that were announced in the budget at the end of October. So this afternoon, I'm going to cover a timeline of those inheritance tax changes, the potential of those changes on you, giving some worked examples, and talk about some of the ideas that you could think about to mitigate the impact of these changes on you and your families. Before I go into the detail, it's worth explaining that the changes that have been proposed are very much in headline terms at the moment. We do not have draft legislation yet, and in the case of the agricultural and business property relief changes, there's been very little detail released so far. We're expecting consultation documents to be issued early in the new year, and we will of course keep these under review as and when they are released. So what I'm going to talk about is based on the guidance that's been issued by HMRC, and in some cases how we expect the new rules to be introduced. But we'll have to wait for some of the detail to have more certainty, and as a result it may not be appropriate to implement tax planning straight away before we have that certainty. And as Mike said in his introduction, it's really important that you don't panic and we take our time to understand what the new rules really mean. So what are the rules today and what do we expect to change over the next few years? It's really important to highlight that no changes to inheritance tax are in force yet. As we stand today, there's up to 100% unlimited business property relief, or BPR, and agricultural property relief, or APR, on qualifying assets. And the vast majority of pension funds are outside the scope of inheritance tax. And we're not expecting any changes until April 2026. So we have just over 16 months until any changes come into force. I think it's worth a brief reminder of the types of assets that qualify for APR and BPR, so you know whether this is relevant to you or not. Unlimited 100% APR is currently available on UK land and buildings that are used for the purposes of agriculture. And the relief is available whether you are farming or whether you're renting the land and buildings to others who are using them in their farming business. If you're using the land, you need to have owned it and farmed it for 2 years, whereas if someone else is using the land, you need to have owned it and they need to have used it for a period of 7 years. It's important to remember that APR only applies to the agricultural value of an asset, which may be lower than its open market value. For example, if it has amenity value for pony paddocks, for example, or hope value for potential development. And there are some limited circumstances that you can see on screen there where only 50% relief is available. Moving on to BPR. BPR is available on trading businesses, but those are sole traders, partnerships, or shares in unquoted trading companies. And unlimited relief is available at 100% on these assets. 50% relief is available on assets that you own personally, but are used in the trade of a company that you control or in a partnership of which you're a partner. You need to have owned the asset for 2 years to qualify, and the business needs to be wholly or mainly trading. And that means that more than 50% of the business is trading. Non-trading activities include holding investment property or investments. So BPR is not available on property investment companies or buy-to-let portfolios. It's worth noting that there have not been any significant changes to the qualifying conditions for APR and BPR. So what changes were announced? From April 2026, 100% BPR and APR will be capped at £1 million per individual. So married couples can have up to £2 million of qualifying assets between them. But based on the current guidance, the £1 million per individual will not be transferable between spouses on death. And this is different from most other inheritance tax allowances, which can be transferred between spouses on death. This might be something that changes through the consultation process and when we get to the legislation. Any value over that £1 million allowance will then receive 50% relief, and the remaining 50% that is taxable will be taxed at 40%, so the normal inheritance tax rate. This gives an effective rate of inheritance tax of 20% on the value of APR and BPR qualifying assets over £1 million. As Mike highlighted, whilst lots of the press coverage has been around APR and the impact on the family farm, the same rules will apply to private company shares, partnerships, etc., albeit potentially with different levels of profitability and liquidity. Shares on more minor stock exchanges, for example the alternative investment market AIM, that currently benefit from 100% relief, will only qualify for 50% relief and will not be included within that £1 million limit. And assets that qualify for 50% relief today will continue to do so and again won't use up that £1 million allowance. As I suspect many of you know, if you make gifts during your lifetime and then you die within 7 years of making the gift, the value of the gift that you made may be subject to inheritance tax. If you gifted APR or BPR qualifying assets, then subject to various conditions, this relief could still be available to exempt that failed gift from inheritance tax. If you make gifts of APR or BPR qualifying assets after budget day, so the 30th of October, and die after the 6th of April 2026, but before the 7th anniversary of making that gift, then the first £1 million would qualify for 100% relief, and the balance would then qualify for 50% relief, potentially with the benefit of taper relief to reduce the tax that's payable if you live for more than 3 years from the date of the gift. So whilst we don't have all the detail and the rules aren't yet in force, they could affect gifts that you make after budget day. So I've talked about the changes from April 2026. A year later, so from the 6th of April 2027, pension death benefits will be included in estates for inheritance tax purposes, and Terry's going to talk more about this later on. So I've explained how the rules are changing, but what could that mean for you? I think the best way to demonstrate this is with a couple of case studies. So in this scenario, we have a husband and wife with assets of about £5.5 million split between a house, pensions, cash, investments, and a trading business. Currently, their wills are drafted so they leave all of their assets to the surviving spouse, and then following the second death to their children equally. So a fairly typical situation. Based on today's rules, the full value of the business, the £3 million of the value of the business, is exempt from inheritance tax, as are their pensions, meaning a total of £4 million of their assets are exempt from tax. After deducting the nil rate ban, the tax-free amount, £850,000 of their estates are subject to tax, and £340,000 of inheritance tax would be payable. And due to the way their wills are structured, this tax would only be payable on the second of their deaths. From April 2026, because they leave all of their assets to the survivor, and the £1 million BPR allowance is non-transferable, only the first £1 million of value of the company is exempt, and the remaining £2 million of value qualifies for relief at 50%. So the changes to the BPR rules increase the inheritance tax exposure by £400,000, being 20% of the £2 million of value over and above the £1 million allowance. And as you can see, this more than doubles their inheritance tax exposure and shows the importance of having tax-efficient wills that Gemma is going to talk about later. If we then move on to April 2027, the pensions then come into the inheritance tax net as well. And this means an extra £1 million of value being taxable, and so an extra £400,000 of inheritance tax. So by the time all of the new rules are implemented, the increase in inheritance tax compared to today is £800,000. And there's been a more than 3 times increase in their exposure. The effective rate of tax on their estate increases from just over 6% today to over 20% from April 2027. So whilst this example shows a client with trading company shares, the same principles would apply to a client with farmland and buildings that currently qualify for APR. I appreciate that many of you will not be business or farm owners, so I wanted to show the potential impact of the pension changes in isolation. So in this example, we have a couple with £3 million of assets, including a house, cash, investments and pensions. And again, their wills are drafted to leave all of their assets to the surviving spouse and then on to the children. Under the rules today, the pensions are exempt from inheritance tax, and because their assets are less than £2 million, they benefit from the full residence nil rate band, which is an extra allowance of £175,000 per person in addition to their normal nil rate band of £325,000. So this gives them a total of £1 million as a couple, which is inheritance tax free, and means that on total assets of £3 million, they will pay inheritance tax of £400,000. From April 2027, the pension then becomes subject to inheritance tax, and the position changes very significantly. Not only is there an extra £1 million in their estates as a result of the pensions being taxable, but they lose the benefit of that residence nil rate band because their assets, or the value of their assets, are over the threshold. So in this scenario, the inheritance tax exposure increases from £400,000 to £940,000, effectively giving a 54% tax rate on the value of the pension fund. So having seen these examples, what are the key messages? As a result of the changes that have been announced, more of you will be subject to inheritance tax. And if your estate was already going to be subject to IHT, it's likely that the tax liability is going to increase. So it's important for you to understand what the impact of these changes is based on your personal situation. And whilst IHT planning has always been important, these changes are going to make it relevant to even more clients than before. Before I talk about some of the planning opportunities that you might want to consider, there are some overarching principles to have in mind. As I said earlier, we don't have all the details of how the new rules are going to apply. This is particularly the case for the APR and BPR rules, and how these will apply to transfers between now and April 2026. We really need to understand what those rules are going to be before we implement any planning. You must remember that for gifts to be effective for inheritance tax, they must be made with no strings attached, and you cannot retain a benefit. If you retain a benefit from an asset you've given away, the value stays in your estate for IHT purposes. One way to prevent this, particularly if we're thinking about property, is to pay a full market rent for the use of an asset that you've given away. But if you need the asset to generate an income that you need to fund your lifestyle, transferring it may not be appropriate. So it's really important to look ahead at your future income and capital requirements when you're thinking about what you might want to be able to give away. And the decisions you might take will not all be about tax. If you're thinking of giving assets away, are you happy for those to go to individuals? Do you know who you want to benefit today, or do you want some flexibility as circumstances might change? Do you think your beneficiaries are old enough or responsible enough to receive significant value? Do you want to be able to say how the money is spent, perhaps on buying a house, but not spent on fast cars and holidays? Are you concerned about divorce? All of these non-tax factors will affect the planning that you might want to implement. So I'm going to talk about some headline planning ideas, and these are just a selection of things that might be worth considering. And I suspect we'll see clients use several of these ideas in combination. It's vital that any planning is tailored to your personal circumstances and what you're looking to achieve. So what planning could you be thinking about? I mentioned earlier that the £1 million APR and BPR allowance is not currently expected to be transferable. If this is the case and one half of a married couple owns all the assets and the other spouse dies first, their potential £1 million of relief will have been lost, costing £200,000 in tax. Unfortunately, it's not always possible to predict the order in which a couple will die, and so having all the assets owned by one person may not give the best result. This means we should be thinking about transferring assets so both spouses have £1 million of APR or BPR assets where that's relevant. And transfers between spouses can generally be done inheritance tax and capital gains tax free. But if you're thinking about land and buildings and there's debt secured on the property, this could give a stamp duty land tax or SDLT charge because there's no spouse exemption from SDLT. You may also need the lender's consent to the transfer and for your spouse to be added to the loan. It's worth noting that when assets are transferred between spouses during lifetime, the ownership period is not transferred, but it is if assets are inherited on death. We think because of all of these changes to inheritance tax, we will see more lifetime transfers of agricultural and business assets, whereas previously people have held on to them until death, benefited from the 100% relief and benefited from a capital gains tax-free uplift. So if you gift assets to individuals during your lifetime, these are something called a potentially exempt transfer. They will be exempt from inheritance tax if you live for at least 7 years from the date of the gift. And as I mentioned earlier, if you live for more than 3 years, any tax on the gift will be tapered. It's really important to note it's the tax, not the value of the gift itself. If you gift APR and BPR assets during your lifetime and you live for 7 years, our understanding or expectation from the limited guidance that we've received is that your £1 million allowance would be available to offset against the qualifying assets that you still own when you die. If you're gifting assets like land or shares, you need to think about capital gains tax. Many business assets and agricultural assets will qualify for something called holdover relief, and that means that you can transfer them with no upfront CGT liability. The qualifying conditions for holdover relief on gifts to individuals are quite complicated, and only partial relief may be available in certain circumstances. Assuming holdover relief is available, this defers the gain until a later sale and means that the person who's received the assets takes on your base cost of the asset. This doesn't make the gain go away, but it means that it's deferred until a later disposal when cash should be available from a sale. With an outright gift, you've given it to one particular individual, you will lose control and flexibility. It's a one-way street, and there's no asset protection in the event of divorce. And stamp duty land tax would also need to be considered if you're transferring land with debt secured on it, and you would need to get consent from the lender. It's important to note that SDLT is only charged on consideration, not on market value. So if it's an outright gift, there'll be no SDLT, but taking on debt is consideration for these purposes. If you're concerned about flexibility, control, and asset protection that would be associated with outright gifts, a transfer into a trust might be something to consider. So a trust separates control, which rests with the trustees, from the benefit of the asset, which rests with the beneficiaries. This means that you don't have to decide who's going to benefit from the asset or income when you make the gift, and it therefore provides flexibility. The trustees can decide if and when a beneficiary receives value from the trust. You can transfer up to your available inheritance tax allowance or nil rate band into a trust without incurring a lifetime IHT liability. And normally that means you can transfer up to £325,000 of value into a trust before incurring a lifetime tax charge. But you might be able to transfer for much, much more value if the assets qualify for APR or BPR. We think there's a window of opportunity to transfer significant APR or BPR qualifying assets into trust before April 2026 with no upfront tax cost. But this opportunity will disappear when the new rules come into effect in April 2026. What's not clear is whether that £1 million allowance I've talked about will be refreshed if you live for 7 years from the date of the gift into trust, or whether if you use it on a transfer into trust, that is your one and only opportunity to use it, and therefore it won't be available on your death. We need to wait until the details are released in the new year to understand that in more detail. You can almost always hold over the capital gain on transfers of assets into trust, and so defer the CGT charge until a later disposal. But again, if it's land and buildings and there's debt secured, we'll need to think about SDLT. So why are trusts interesting from an inheritance tax perspective? Well, they don't form part of any individual's estate for inheritance tax, so there's not a tax charge on anyone's death. Instead, trusts are subject to a small inheritance tax charge every 10 years at a lower rate, which currently is a maximum of 6%. But if the trust owns assets that qualify for APR or BPR, that would then be at a maximum rate of 3% every 10 years. We expect trusts created before the 30th of October this year to each have their own £1 million APR and BPR allowance, whereas trusts created by the same person after budget day will share a £1 million allowance between however many trusts you set up. So moving now on to company shares, which may well affect a number of you in the audience. Many of you will be aware that if you own less than 100% of a private company, the shares that you hold will be subject to or benefit from a minority interest discount, which means that if, for example, you have a 50% interest in a company, that will not be worth 50% of the total value of the company. And the value of a 49% interest, which does not give you control, would be significantly less than the value of a 51% interest that would give you control. So thinking about how the shares are owned and whether a transfer of a small number of shares could have a significant impact on your potential IHT exposure should be considered. And whilst I've been focusing on BPR and therefore trading companies, this is also relevant for investment companies that do not qualify for those valuable tax reliefs. If you're thinking about transferring shares, then please do remember that transfers of shares are likely to trigger CGT liabilities. And you could also think about changing or creating new classes of shares in the company, with different shares having different rights to value in the event of a sale or winding up of the company. This could mean that the current value of the company rests with the current shares, known as freezer shares, but future increases in value accrue to the new class of shares, which might be known as growth shares. There are some valuation considerations here, and our forensics and valuations team can advise on that. But broadly, these growth shares would have a relatively low value on day one, and these could be gifted either into a trust or outright to individuals with little or no upfront tax cost. And this means that future increases in the value of the company could be outside of your estate, and whilst it may not reduce the inheritance tax charge on the value of the company today, it could stop the problem getting worse as the company increases in value. So that's a bit of a whistle-stop tour of some of the planning options that we would be thinking about. Some other planning options or opportunities relate to how your wills are structured, what to do with your pension, and thinking about life insurance. And Gemma and Terry are going to talk about these later. I hope that's explained the impact of the rules and some things that you could be thinking about, and I will now hand back to Mike.
So thank you, Daniel, for that. Clearly, these changes will have a significant impact on a lot of business owners and individuals, and there's obviously a lot more detail still to come out over the coming months. The other point is probably should be noted that the tax due on agricultural or business property relievable assets can be paid by instalments over 10 years without interest charges. So there is a little saving grace, albeit it's not very big. So we're now moving on to the first of our poll questions, which you should see on your screen coming up now. So we would just be interested in some feedback on which of the inheritance tax changes you individuals are most concerned about, be it agricultural property relief, business property relief, pensions, or all of the above. So we'll just leave that on the screen just for a few seconds to see what responses are coming in. And also, okay, so that's interesting. So out of those three individual sectors, pensions is by far the biggest one that's coming up from the audience at the moment. All covering almost a quarter of the audience as well. So probably not totally unanticipated in terms of the responses. Just another quick reminder, just moving on to a quick reminder about questions, so please do keep putting your questions in. We have got a number of them coming through. But next we have Gemma covering the importance of reviewing your wills, the use of trusts and lifetime gifts. So over to Gemma.
Hi, hopefully you can hear me okay. Well, I'd like to say I'm here to offer a little light relief from what is clearly a very meaty topic. However, as Mike's explained, I'm the lawyer here to talk to you about wills, so I think it's safe to say the topic isn't about to get any cheerier anytime soon. So hold on to your seats, as we delve a little deeper into inheritance tax planning and consider how your wills could be used to help mitigate inheritance tax in light of the recent changes. So I'd briefly like to just cover where we are now in light of the budget, reflect on where we were several years ago and where I think we're heading in terms of will planning. And you'll see there is a little bit of a theme. So as you're no doubt aware, the budget has put a further freeze on the inheritance tax threshold until 2030. And with the value of properties continuing to rise, more and more estates are likely to be impacted by inheritance tax, even before the changes to APR and BPR come into effect and pensions are introduced to estates. Daniel has explained that the current nil rate band is £325,000 and that's transferable between spouses, so that together they can give £650,000 tax-free to non-exempt beneficiaries. In addition, each person has what's called the residence nil rate band, which is currently worth £175,000. When that relief is added to the nil rate band, it gives individuals up to £500,000 that can pass tax-free, so that together couples can give up to £1 million tax-free. However, it is a complicated piece of legislation and it doesn't apply to everyone. Put very simply, in order to claim the residence nil rate band, one must own their own home, which they've lived in during the period of ownership. They must have equity in that property worth at least £175,000, and they must leave that property on death to their direct descendants. That could be children or grandchildren. It can include stepchildren, but it excludes nieces and nephews and other family members. So it won't apply to everybody. It certainly won't apply to anyone who doesn't have children. Those direct descendants must inherit the property immediately on death, and the relief will be tapered away by £1 for every £2 an individual has over £2 million. So once a person is worth 2.35 million, they will lose the relief altogether. BPR and APR assets are included in a person's estate for considering the £2 million threshold. And from April 2027, we expect pensions will also be included. So far less people will be able to claim this relief than they already do. Interestingly, it is worth noting that gifts made within 7 years of death, whilst taken into account for IHT purposes, are not taken into account in considering the £2 million threshold. So for those of you who have a crystal ball, you could consider giving significant gifts away prior to death to keep the value of your estate within that £2 million threshold. So I feel as though I need a 1980s soundtrack or a picture of a DeLorean to introduce this next slide as we go back in time. One of the things that struck me as very odd when considering the impact of the changes is that we seem to be going back in time. I remember when I first qualified as a solicitor, nil rate band trusts in wills were all the rage. I expect many of you may know what I mean by these, and you may even have had them in your wills. It used to be the case that individuals had their own inheritance tax allowance, known as the nil rate band, and once upon a time, that used to increase each year to keep up with inflation. That relief was specific to individuals and was not transferable between spouses. This meant that if couples chose to leave everything to the survivor on first death, they were doubling the size of the survivor's estate, but could only apply one nil rate band against two people's worth of assets. The nil rate band of the first spouse to pass away would be lost entirely. This was at a time when the residence nil rate band didn't exist, and in this slide I've used the current nil rate band of £325,000 as that's what we've all become used to. So some clever person introduced the concept of nil rate band trusts to wills. The purpose of them was to ring fence the maximum amount that could be given tax-free by transferring that amount into a discretionary trust. The surviving spouse, along with the children and possibly other family members, would be included as beneficiaries of that trust. The remainder of the testator's estate passed outright to the surviving spouse under the spouse exemption. This meant that on first death, there would be no inheritance tax liability, and the value of the nil rate band had been utilised. For those who could afford to give it away, the nil rate band trust would be wound up in favour of possibly the children or other non-exempt beneficiaries, but for many, the surviving spouse would likely need those assets, especially if it consisted of a half share in the family home. The trusts were created to be flexible so that the trustees could choose to lend assets to the surviving spouse in exchange for a promise of payment, and in some cases an equitable charge might be placed over the property. This would enable the survivor to be free to use the assets as they pleased during their lifetime. And then when they passed away, the trustees would call in the debt as a liability on the survivor's estate. This would reduce the value of the estate by the nil rate band, and in addition, the executors could then claim that survivor's own nil rate band to enable them to claim 2 nil rate bands in what was quite a convoluted way. So the government came to their senses, and in October 2007, the rules changed to allow spouses to transfer allowances on death so that both allowances could be claimed at the rate that applied at the second death. This made estate administration and wills much easier to administer. I was expecting to see something similar with the budget when the £1 million cap was introduced to 100% BPR and APR. However, so far there's been no sign of that relief being transferable. So where to next? So far as I can tell, we seem to be heading back in time where it will become necessary to create discretionary will trusts to ring fence the relief that will otherwise be lost on second death. In Daniel's first scenario, if we consider Daniel's advice to share the BPR, APR assets equally between Mr. and Mrs. Smith in their lifetime, they could each then, in their wills, create a discretionary trust. The assets passing into that discretionary trust on first death will need to be carefully considered and defined. Essentially, what we need to do is claim up to £1 million worth of assets that qualify for 100% BPR, APR, so that they pass into a discretionary trust. The beneficiaries of that trust will need to include the surviving spouse together with any beneficiaries that the couple together would want those assets to pass to when they both pass away. So if we now revisit Daniel's scenario of Mr. and Mrs. Smith, you can see the figures are changed quite a lot here. We can save up to £200,000 in tax just by creating these trusts in the wills. So it's certainly worth considering. Some people may already have trusts in their wills to ring fence those business assets. So will they still work? Well, the big thing here is to consider the fact that there is this £1 million cap on 100% relief. So the first question you've got to ask yourself is, what is the value of the assets that would pass into the trust? If they're under £1 million, then perhaps the trust is still okay, but you will need to continue to review the value of that trust. If the assets are worth more than £1 million, then there would be an immediate charge to inheritance tax on first death if no action is taken. So my recommendation would be to review this trust with us so that we can determine any changes that ought to be made now or in the future. If no changes have been made to the will and death occurs before April 26, the trust will still benefit from the full IHT relief. However, if no changes are made and death occurs in April 26 onwards, action would be necessary by the trustees to mitigate tax. One option for the trustees would be to leave in the trust BPR, APR assets worth up to £1 million and transfer the balance to the surviving spouse so that the spouse exemption could be claimed on the balance. Your trustees will need to be aware of this option, so I would strongly suggest that your letter of wishes, if nothing else, is updated to reflect this. If in doubt, speak to us. And finally, there's a lovely little saying in the tax world called "don't let the tax tail wag the dog." Sadly, we can't offer a one-size-fits-all solution. As Daniel has explained, there are various factors to consider, and each person's circumstances need to be taken into account in considering the suitability of a trust such as this one. It relies on having trusted persons to act as the trustees of the discretionary trust. The trust is discretionary by nature, and so whilst the testator can provide guidance in a letter of wishes, there is no guarantee that the trustees will be able to, or even be able to follow or understand the wishes. The nature of the assets may make it very difficult to split up and carve out £1 million in value to then be operated by the trust, and the survivor might not wish to be constrained by the rules of a trust, knowing that they don't have absolute freedom to do as they please with the assets. Trusts are administratively complex, particularly now that trusts such as this one would have to be registered with the government's trust registration service, and ongoing tax compliance would be necessary, as well as the need for the trustees to seek regular tax advice, all of which comes at an expense. However, the tax advantages may be too great to ignore. As Daniel's highlighted, the changes on death haven't come into force yet, so whilst we would like you to start considering whether your estate will be impacted and whether a trust might be suitable for you, it's worth remembering we're still in the consultation period where further changes could take place. So our message to you is to remain calm, but don't become too complacent. Once the consultation period concludes and the legislation is finalised, there will be a limited window to make necessary changes to your wills. There'll be a pop-up window at the end of the webinar with a survey, so if you would like us to get in touch with you, please let us know. And I think that's probably enough from me, so I'll hand back to you, Mike.
Thank you, Gemma. So clearly there's a need for wills and trusts to be reviewed ahead of these changes being introduced, although it will be interesting to see if the government relaxes the proposed rules to allow the transfer of the £1 million APR and BPR allowance to their spouse if it's not used on the first death. So we've now got a quick second poll just coming up on the screen for audience participation. So we're interested in what level of impact do you think these inheritance tax changes will have on you? So no impact, little impact, or significant impact. So I'll just leave that up on the screen for a few seconds just to give as many as possible the opportunity to answer. So probably as anticipated, 80% of the respondents are saying significant impact, 19% little impact, and interestingly 2% no impact. So I know we also have a number of farming businesses on the webinar this afternoon, and there's certainly a disconnect as the government stated that less than 500 farms will be affected by these changes, whereas compared to those in the industry of sector bodies and advisors like us working in the sector, it's believed to be over 70,000 farming businesses will be impacted. And again, as I mentioned earlier, the press focus does seem to be on farming businesses, but doesn't have yet picked up on the impact on all other businesses and their owners. So again, just a quick reminder to please keep your questions coming in, but moving on swiftly, finally, I'll hand over to Terry, who will be covering pension planning options, life insurance, and other investment products to help mitigate the risk. Terry.
Yeah, thanks, Mike, and good afternoon to everyone. I'd now like to focus on the proposed changes to pensions from April 2027, which will bring unused pension funds and certain death benefits into the scope of inheritance tax. So currently, pension funds are generally free from inheritance tax on your death, but as from 6th of April 2027, undrawn pension funds and certain death benefits will become part of an estate subject to inheritance tax. So on the next slide, we look at the proposed changes. So up till April 2027, pensions will continue to be considered outside of your estate for inheritance tax purposes in most circumstances. This means any unused pension funds can be transferred to your beneficiaries following your death free from inheritance tax. Where you die before age 75, your beneficiaries may also receive death benefits via a lump sum or a beneficiary's income drawdown arrangement without paying any income tax. The availability of a beneficiary's income drawdown option is dependent on the options provided by your pension scheme, as well as the death benefit nominations you have made. This may result in your unused pension passing to your beneficiaries free of all taxes. Currently, where death occurs beyond age 75, your beneficiaries will be subject to income tax on any death benefits received, up to their highest marginal rate. This could result in an income tax liability of anywhere between 0 to 45%, dependent on your beneficiaries' other income, but currently no inheritance tax will be taken in most circumstances. So how will things change? So post April 2027, unused pension death benefits will be brought into your estate. Exemptions will apply for pensions left to your spouse or civil partner, and also benefits left to charity. Your pension funds will receive part of your available nil rate band based on the proportional value of your pension benefits against your non-pension estate. This will mitigate inheritance tax on part of your pension fund. Inheritance tax will be paid by the scheme administrators from the pension, and your pension may only pay the inheritance tax due on your pension and cannot be used to pay tax due on other assets. Any income tax payable by your beneficiaries on the remaining death benefits will still be dependent on your age at the date of your death. Again, as it is now, where death occurs before age 75, it may still be possible to transfer funds free of income tax, resulting in a tax liability of inheritance tax only, 40%, on the proportion of pension benefits subject to inheritance tax. Where death occurs post 75, income tax will continue to be payable at the beneficiary's highest marginal rate, as per the current treatment. Therefore, for pension funds subject to both inheritance tax and income tax where death occurs post age 75, this could result in an effective total tax rate of anywhere between 40 up to 67%. Now, before we consider any immediate action, we should remember the following important points. The rules will not change until 2027, and therefore pension benefits still remain outside of your estate in the short term. Consultation is underway as to how the rules will be implemented, and we should know more by early next year. So a wait and see approach may be sensible in the short term should any details of the proposals change. Pensions also still offer the most tax efficient solution for your retirement needs. You still get income tax relief on pension contributions up to 45%. Your pensions still grow free from income tax and capital gains taxes, what we call gross roll-up, which helps with the compounding of investment returns within the scheme, and you will still benefit from your tax-free cash allowance when drawing your pension benefits. But please remember that the correct drafting of pension death benefit nominations remains important going forward to maximise the tax-free funds for your beneficiaries, especially for larger pension values beyond the death benefit allowance that's available. So let's return to the case study of Mark and Jane, see what actions they may consider taking to mitigate inheritance tax on their pensions. Firstly, I'd always recommend that they fully understand the scope of any future tax liability that they may face and the level of wealth that they need to retain to meet their own individual lifetime needs and for contingencies such as long-term care, the loss of income following the death of the first spouse, to be but two of them. Completing cash flow planning will help you understand these factors and help you to decide the most appropriate method of planning for inheritance tax. This may include deciding upon the level of affordable gifts, whether directly or via an appropriate trust option. Where a trust is used, you may be able to afford to make an outright gift of capital and income, or you may need to retain access to income or capital via the use of discounted gift trusts or loan trusts. Additional options such as using schemes that benefit from business property relief at 100%, or even still holding AIM shares that now only get relief at 50% will still remain suitable in a lot of cases. And the use of life insurance to cover your potential inheritance tax liability still remains suitable as well. So what can Mark Jane do once they understand the extent of the problem and have reserved their funds that they need for their lifetime needs? They could consider leaving their pensions directly to their children rather than each other to benefit from the current rules that remain should one of them die before April 2027 and avoid income tax in the event of one of them dies before age 75 with a subsequent death post age 75. They could draw tax-free cash from their pensions, free of any immediate income tax, gift this to their beneficiaries or a suitable trust. Where they survive for 7 years, they will have passed these funds free from both inheritance tax and income tax to their beneficiaries. They could guarantee a tax saving if they use life insurance to cover the qualifying period of 7 years until the gift becomes exempt. They could draw further pension income, subject to their own personal income tax rate, and then gift this within the annual or surplus gift from income exemptions to avoid the potential double taxation of both income tax and inheritance tax if they die post age 75. Finally, they may consider using a whole of life insurance policy to pay all or part of any future inheritance tax liability if they do not wish to gift any assets at this time. This is likely to reduce the real cost of inheritance tax. So this slide looks at the benefits of changing death benefit nominations in favour of Mark and Jane's children. Currently, if Mark dies pre-age 75, all pension funds are passed to Jane, free of inheritance tax and free of income tax in Jane's hands. If Jane dies later, post-April 2027, and after passing age 75, then no death benefit allowance is available to pass funds on free of income tax. As the pension now forms part of Jane's estate, it may reduce the availability of the residential nil rate band if it increases the death estate value beyond £2 million. The pension will therefore increase the level of inheritance tax payable at 40%, with the post-age 75 death benefits also being subject to income tax in the beneficiary's hands. As an alternative, where it is affordable, Mark may pass any pension death benefits directly to the children on the first death. Sorry, I just covered that point. So if we go on to the next slide. So this slide looks at making potentially exempt transfers and guaranteeing a tax saving even when you die within 7 years before the gift becomes exempt. In this example, Mark draws his tax-free cash of $125,000 from his pension, free of all taxes. He then gifts these funds either directly to his family or via an appropriate trust. If Mark dies within 7 years, the gift will be assessed for inheritance tax and may result in a liability of £50,000. However, Mark decides to take a 7-year term assurance policy to protect this risk. For a 70-year-old man accepted on standard terms, this costs him a little under £40 a month, or just over $3,300 over the entire 7-year term. The premiums may be exempt from inheritance tax under the annual gift or gifts from surplus income exemptions, and the policy is written in trust, removing the benefit from Mark's estate and allowing his children to obtain the funds without the need for probate, which can then be used to pay any outstanding inheritance tax and reduce the need to sell other assets within the estate. Irrespective of how long Mark lives for, he has secured a guaranteed inheritance tax saving of just over £46,000 after taking the cost of the insurance into account. Finally, we look at using whole of life cover. In this example, you will recall that the changes to the rules leave Mark and Jane with an additional inheritance tax liability of £800,000 as per Dan's earlier analysis. Mark and Jane do not wish to gift any assets at this time. However, they may continue to enjoy significant surplus income. So they could arrange a whole of life insurance policy which pays out once they have both died. Where they are age 70 at inception and accepted on the standard terms, they attain a guaranteed monthly premium of just under £1,400 a month, which will not change, to provide a sum assured of £800,000 on the second death, which is equivalent to the increased tax burden. Premiums may be exempt under the gifts from surplus income exemption, possibly paid by drawing income from their pensions. The policy is again held in trust to avoid inheritance tax and any wait for probate. In this example, if Jane survives Mark and dies at age 90, by this point a total of £334,000 has been paid in premiums for a sum assured returned of £800,000, providing a saving of circa £565,000 against the inheritance tax due. So that wraps up my presentation, and please feel free to submit any questions you may have for me in the questions and answers slot, which is coming next.
Thank you, Terry. And as been mentioned previously, the message at this stage must be not to take any knee-jerk reactions, but start thinking about and discuss the planning options with your advisors to put some plans in place and see if any of these changes may be watered down over the next few months. Finally, we'll just quickly move on to our final poll as we're running a little over time, although we will be staying on for an extra 15 or 20 minutes as we've got quite a lot of questions coming through. So the final poll: what is your priority over the next 12 months? Reviewing your will, reviewing or transferring assets, undertaking a pension review, or all of the above. So again, we'll just leave that on the screen just for a few seconds. And please do keep feeding your questions in. And as I say, we'll stay on the webinar just for another 10, 15, 20 minutes to now enable all those questions to be asked. So in terms of the response to that poll, so all of the above seems to be the majority, which again is probably not totally unexpected, with the three individual areas being broadly equal. So if I can perhaps just ask all of the panel to come back on screen, and we'll just move into our question and answer session. If we aren't able to answer all your questions today, then we will follow these up after the webinar. And again, please do just leave questions using the functionality that's on the screen at the moment. So without further ado, I think firstly I'd just like to move into the questions. So the first one we've got from Michelle: I have a family trust that owns shares in a private trading company, which I understand qualifies for business property relief. Are there any steps I should be considering now before the rules change in 2026? So Daniel, that's probably one best placed for you.
Yeah, thank you, Mike. I think that's a really good question. So if you've got a trust that owns shares in a private company and they do qualify for business property relief, then if you wanted to take them out of the trust, then you could do that before the 6th of April 2026 with no inheritance tax charge and probably no capital gains tax. So if you've decided that the trust has served its purpose, perhaps the beneficiaries are a bit older, or you've now got clarity about who wants to or who should own those shares, then potentially distributing those shares from the trust before April 2026 would be a good thing to do. After April 2026, it's likely there's going to be a maximum of a 3% tax charge to get those shares out of the trust. But I think it's definitely worth thinking about. What I would say, we don't have lots of detail on APR and BPR rules, particularly around trusts and particularly around what may or may not happen before April 2026. So we do need to wait for that guidance and the consultation that's coming out early next year.
Thank you, Daniel. One for you, Gemma. This is from Carol. So my will is with my former solicitors. Do I need the original in order for you to review it?
Thank you, Carol. No, just a copy would be fine. If we make a new will for you, then it will automatically revoke your older will. So at that point, I'd recommend that you retrieve your older will just so that you haven't got lots of versions out there. But no, we don't need the original.
Thank you, Gemma. One for you, Terry. From Richard, what can I do if my pension scheme does not offer a beneficiary's income drawdown benefit?
Okay, so the beneficiary's income drawdown benefit is important because if your pension exceeds the lifetime allowance, or the death benefit allowance, I should say, then the excess might be taxed at your beneficiary's marginal rate of income tax. So if you haven't got that option available, then you can transfer the pension to a scheme that does. You need to make sure it's obviously the right thing for you and that you're not giving away any valuable guarantees, such as guaranteed annuity rates or protected tax-free cash, which is of course something that we can look into for you and to make sure that the new scheme is a good scheme. And you also have to be careful, though, because if you die within 2 years of transferring your pension, even now, the pension may be brought into your estate for inheritance tax even before April 2027.
Thank you, Terry. This is a bit of a double question, so perhaps Daniel and Gemma are best placed to cover both of these, if that's okay. So from Debbie, how quickly does my inheritance tax have to be paid before a person has died? And from Clive, is the interest-free instalment offered just to farmers, or does it apply to all instalment payments on business assets? So perhaps, Gemma, did you want to pick up the first point?
Sure. So you have 6 months from date of death before interest will accrue. So that would be the key time to start. In terms of what assets are available before you have probate, I know it's a bit of a chicken and egg situation, but if the deceased had cash in bank accounts, national savings products, then generally those are all accessible and could be transferred directly to the revenue and payment of tax prior to getting probate. And then, Dan, do you want to answer the question about interest?
Yeah, so Mike mentioned earlier that where you have assets that qualify for either agricultural or business property relief, then you can elect to pay that tax over 10 years. And rather generously, the revenue don't charge interest on those instalments. That's both for APR and BPR qualifying assets, because it's been at 100% for most qualifying assets over the last 32 years or something. It's not something that we've had to look at in a huge amount of detail. So that's a benefit. There are other assets that you can elect to pay by instalment. So all land and buildings, you can elect to pay the inheritance tax over 10 years by instalments, but their interest is charged on those instalments. So the interest will run from 6 months after the date of death, as Gemma's talked about, for each of those instalments, but that interest is not charged on APR or BPR qualifying assets.
Wonderful, thank you both. Terry, one for you. Are SAS schemes affected by the new budget? So you might just want to expand on what a SAS scheme is in terms of the definition.
So a SAS scheme is a sophisticated version of an occupational pension scheme, which normally is the members are normally the directors of the company or owners of the company. So basically, a SAS scheme is, as I say, a sophisticated money purchase scheme. So basically, Each member holds a value within the scheme, and if that member dies, then the value, their part of the scheme, their value within the scheme, will be subject to the inheritance tax regime going forward, as any other pension is as well. So yes, it will be affected.
Lovely, thank you, Terry. Daniel, one for you. How will shares in a private company be valued? That's from David.
Our valuations and forensics teams are the experts on this, but I can talk in broad principles. It very much depends on the type of company that you have. So if you have a property investment company, for example, it's probably on a net asset basis. So what's the value of the assets less the value of the liabilities? If it's a trading company, it's probably on a future discounted cash flow or a multiple of earnings. So it might be 5 times profit, for example, as the starting point, and that gets you to the value of the company as a whole. And then, as I mentioned earlier, you then get something called a minority interest discount. So if you have a small minority interest in a company, perhaps a 10% interest, that might benefit from a 60 or 70% discount for tax purposes. The bigger your shareholding, the less for discount you get, and if you own 100%, there will be no discount at all. So it very much depends on the type of company, but those principles of minority discounts do apply, and that's why moving from, say, a 51% to a 49% shareholding can have a really significant impact from an inheritance tax perspective.
Thanks, Daniel. There's probably one for me, actually. So from Glenda, is it best to have the farmhouse included in the farm for APR or owned separately? Generally, it would be better to put the farmhouse or include the farmhouse within the business, because it could open up possibilities of not only APR but some BPR as well. Care would need to be taken if a company is involved in the structure, just in terms of benefit in kind implications, but generally it's best to bring those in. Another one for Gemma. What is the maximum lifetime gift amount that can be made either in one go or over time?
Whatever you can afford, really. There is no maximum, so it is just about considering what you can afford to give away, knowing that it is, as Daniel said, no strings attached. So it's known as a potentially exempt transfer, which means provided you survive 7 years, it will be treated tax-free. But if you die within 7 years, that taper relief applies, as Dan was explaining.
Thanks,
Can
Gemma.
I just add to that, Mike? Can I just add to that? That's absolutely right if it's an outright gift to individuals. If people are thinking about making gifts into trust, then if you give more than £325,000, then you'd get an immediate lifetime inheritance tax charge. But if we're talking about gifts to individuals, then as Gemma said, there's no limit apart from what you can afford.
And that's quite a good segue into the next question from Sam. What are the advantages of transferring assets into a trust compared to transferring them outright to individuals, Daniel?
So there are some tax benefits, and there are some sort of asset protection and control benefits. So if we think about the non-tax benefits first, a trust offers you asset protection. So you're separating the people who benefit from the assets from the people who control them. So the trustees control them and the beneficiaries benefit from them. So that means if you've got relatively young beneficiaries, that you can protect them from that value, you can shield them, and you can decide what that money gets spent on. It also provides flexibility. So if you've got multiple beneficiaries, you can decide how much each one gets, when, or if anything at all. So that provides flexibility. So you might be happy to give value away today, but you don't quite know who's going to benefit from it. And probably one for a family lawyer, but trusts can provide a degree of asset protection in the event of matrimonial difficulty. So there's some asset protection points of view, and then from a tax point of view, you can almost always elect not to pay capital gains tax when you transfer assets into a trust. So if we were thinking about a buy-to-let property, you could gift that into a trust, elect not to pay the capital gains tax, whereas if you gave it outright to an individual, you would pay that capital gains tax, which would be at 24% on the capital gain. So some tax benefits and some sort of broader asset protection and control benefits.
Thanks, Daniel. Terry, one for you from Mark. How does the death benefit allowance work?
So you have a standard allowance of £1,073,100. You may have a higher allowance if you have some of the transitional lifetime allowance protections. That allowance covers your tax-free cash in your lifetimes, which can be up to 25% of the allowance, up to 268,000. And then on your death, anything that's remaining of that allowance, so i.e. the original allowance less any tax-free cash you've taken, can then be used to pass on death benefits from a pension free of income tax to your beneficiary if you die before 75. If you've got an excess beyond your death benefit allowance, then this is where a beneficiary's income drawdown comes into useful, because you can, rather than pay out a lump sum, you transfer it into a beneficiary's income drawdown pension, which the beneficiary can then take income from it free of all tax going forward. But as I say, it's only useful if you die before the age of 75.
Thanks, Terry. Gemma, one for you from Diane. We have business asset protection trusts in our wills already. Do we need to make any changes now?
So I suppose it's just going back to one of my slides, actually. It may be okay, but it would be worth a review, because we need to remember that you only have that £1 million cap on the 100% BPR APR. So it's really a case of understanding what you have, whether it would make sense to incur a tax bill immediately on death or not. So if in doubt, come and have a chat and we'll work it out together.
Thanks, Gemma. Daniel, one for you from Seth. Do your children receive £1 million each tax-free, or is it split between spouses?
So the £1 million allowance is per person who held the asset, so per deceased person. So it's not, if you had 5 children, you don't get £5 million of tax-free allowance. It's £1 million per person who's leaving those assets on their death. So if you've got, so only covers £1 million in total.
Okay, thanks, Dan. Gemma from Paul, should I give my property to my children now?
I don't know whether this was asked before Dan's piece or not, really, but Dan did mention about if you give something away, it does need to be no strings attached. So with a property, you've got to consider where you're going to live. If you still need to live there, are you able to pay full market rent to continue living there? Otherwise, it will be seen as a reservation of benefits. So you also need to think about if you're, I know some people talk about perhaps part owning a property with their children, but again, think about their matrimonial situation. What would happen if actually they die before you and you're sharing the property with grandchildren who could force a sale? There's lots of things to consider. So think carefully before doing any lifetime gifts.
Thanks, Gemma. Terry, one for you from Brian. Two-part question, and including one from Peter. So how will final salary schemes be impacted by the IHT changes? Presumably, if it only provides a widow's pension, it will be spouse exempt. And then from Peter, so far as pension changes are concerned, do you foresee a reversion to the use of various annuities?
So dependents' pensions to your spouse or to your children up to a certain age won't be taxed under inheritance tax rules from defined benefit pensions, and similarly, dependents' pensions from annuities won't come into that regime as well. However, if they receive a lump sum death benefit, then that could be caught by the inheritance tax regime. So that could be, for instance, in relation to an annuity, where you may guarantee a level of income for 5, 10, 15, or even more years. And if that's paid out as a lump sum to another beneficiary, then that could be caught under inheritance tax.
Thanks, Terry. Daniel, question from Tania. Is the IHT instalment option available for a failed pet of cash, which is now comprised of property?
Unfortunately not. So you look at the asset that was given away, and that's what determines whether you can elect to pay by instalments or not. If you received £1 million in cash and bought a property with it, then that tax would still be payable 6 months after the date of death, as Gemma explained.
And stay on the line, Daniel. So from Stephen, you mentioned that the potential for the £1 million allowance will not be transferable, and so assets could be transferred. what tax issues needs to be considered if I want to transfer assets to my spouse?
Assuming we're dealing with people who are all UK, I'll say domiciled now, long-term resident from next April, then broadly you can gift assets with between spouses with no capital gains tax and no inheritance tax implications, so that's good news. As I mentioned in my presentation, if you're transferring land and buildings and they've got debt secured on them, you need to think about SDLT. And we should also be thinking about income tax as well. So if they're income generating assets, how does that affect your income tax liability? Is it moving income into a higher tax environment or lower tax environment? But from a inheritance tax and capital gains tax perspective, then those gifts or transfers can generally take place with no upfront tax cost.
Thank you, Daniel. I think we should probably start wrapping up now. So thank you everyone for those insightful answers and for the great discussions and also the great questions that have been coming in. If there are any additional questions or matters that you would like to discuss further with any one of our team, please do leave a brief description of these on the pop-up survey at the end of this webinar and we'll be in touch. Could I also ask you please to also complete the very short feedback survey at the end so we can continue to improve these webinars and events for you. We do truly value and listen to your feedback. Whether you're already a client working with us or not, if anything has come out of today that you'd like to discuss further, please do not hesitate to contact us. The details are on the screen and we'd be delighted to hear from you. So that just leaves me to say thank you very much for joining us and enjoy the rest of your day. Thank you and goodbye.